Hello, everyone, and welcome back. Today, we're tackling a topic that I know causes a ton of anxiety for CMA candidates. But listen, as someone who has literally lived and breathed this syllabus with students for years, I promise you, once that core idea finally clicks in your head, leverage actually becomes one of the most logical, intuitive concepts on the entire exam. So let's dive right in and strip away all that intimidation factor. Here's our roadmap for this explainer. We'll kick things off with Section 1, the double-edged sword. Then, Section 2 covers operating leverage, followed by Section 3 on financial leverage. In Section 4, we'll combine those for the total leverage chain reaction, and finally, wrap up with Section 5 on some critical CMA exam traps.
All right, Section 1, the double-edged sword. To really grasp what leverage is, think back to basic physics for just a second. A lever is just a simple tool, right? But it allows you to lift a massive, heavy rock with just a tiny amount of applied force. You're essentially magnifying your physical effort. Well, the business application is exactly the same. We're just applying it to money instead of rocks. In business, leverage simply means using fixed costs to magnify your returns. You're building this structure where a really small push at the top line creates a massive movement at the bottom line. It's all about the strategic use of costs that simply do not change when your volume changes.
And that brilliantly illustrates why we call it a double-edged sword. When your sales go up, having high leverage acts like an absolute rocket booster. It skyrockets your earnings way past what a normal company would ever see. But you really have to respect the risk here, because when sales go down, high leverage works in exact reverse, aggressively magnifying your losses. It just amplifies whatever direction your momentum is heading.
Moving into Section 2, operating leverage.
So on the exam, the ICMA tests two distinct types of leverage. To understand the first one, operating leverage, mentally picture the top half of your income statement, from revenue straight down to operating income, or EBIT. This kind of leverage pops up when a company has fixed operating costs. Think factory rent, supervisor salaries, or equipment depreciation. Now, the math looks like this. The degree of operating leverage, or DOL, is calculated as the percentage change in operating income divided by the percentage change in sales revenue. Alternatively, if you're just looking at a base-level financial statement, you can calculate it as contribution margin divided by EBIT. Because your fixed operating costs stay completely flat no matter how much you actually produce, every single additional dollar of revenue brings an exponentially higher operating profit once you push past that break-even point. Now, let's step away from the formulas for a second and use some real business intuition. I want you to imagine a company you're analyzing, and you calculate that they have a DOL of exactly 3.0. What does that actually mean for the business on a day-to-day basis? Well, here's the dynamic breakdown. If your DOL is 3.0, it means a mere 1% increase in sales triggers a full 3% jump in your EBIT. Your profit is literally growing 3 times faster than your revenue. Pretty amazing, right? But remember my warning about that double-edged sword. If the economy cools off and your sales drop by 10%, that DOL of 3.0 means you're going to suffer a brutal 30% loss in operating income.
Okay, here is a massive CMA exam insight regarding real-world application. The exam absolutely loves testing your understanding of different industries. Notice how software companies or heavy manufacturing businesses naturally have high fixed costs. That means they have a high DOL and a much higher break-even point. On the flip side, service businesses, like consulting firms, have most of their costs tied up in variable expenses, like hourly wages, so they naturally run with a very low DOL.
Let's move on to Section 3, financial leverage. If operating leverage was the top half of the income statement, financial leverage shifts our focus down to the lower half, right below EBIT. This happens when a company finances its assets by taking on fixed financial costs, which is usually interest expense on debt. Here's how you measure it. The degree of financial leverage is the percentage change in net income, or earnings per share, divided by the percentage change in operating income. And just like before, from the financial statements, you can also calculate it as EBIT divided by EBIT minus interest expense. Now look really closely at that denominator. If a company has zero debt, their interest expense is zero. That means the denominator matches the numerator, right? EBIT over EBIT, which just equals 1.0. That mathematically proves the company has zero financial leverage. Let's run a quick scenario here to build our intuition, just like we did with DOL. Consider a company where you run the math, and you calculate a DFL of exactly 2.0. The exact impact of a 2.0 DFL looks like this. Say your operations team does a stellar job and generates a 5% bump in operating income. Well, because of your debt structure, that 5% bump translates directly into a 10% increase in earnings per share. Your financial structure is literally doubling the operational gains for your shareholders. While these degrees of leverage are crucial, I have to remind you that the exam will absolutely test traditional balance sheet ratios as well. I'm talking about the debt-to-equity ratio and the times interest earned, or TIE ratio. The general rule of thumb you really need to internalize here is that high debt means high interest payments. That drives up your financial leverage for sure, but it results in a lower times interest earned ratio, which ultimately means a higher risk of financial distress.
All right, Section 4, total leverage and the chain reaction.
So what happens when you combine both types of leverage in one company? You get the degree of total leverage, or DTL. Think of this as the superpower metric. It measures the entire journey from how a change in top-line sales impacts the very bottom-line EPS. The beauty of DTL is that it's just a simple chain reaction formula. You just multiply them together. DTL equals DOL multiplied by DFL. Alternatively, if you want to express it as a single fraction, it's the percentage change in EPS divided by the percentage change in sales. It perfectly combines the operational fixed costs and the financial fixed costs into one unified metric. Let's trace this chain reaction together because, honestly, it is absolutely staggering. If we take our previous operational leverage of 3.0 and multiply it by our financial leverage of 2.0, we get a total leverage of 6.0. The true magnification power here is crazy. With a detail of 6, a relatively small 5% rise in sales explodes into a massive 30% rise in EPS. This exact magnification power is exactly why corporate leaders care so deeply about managing their cost structure and their debt loads simultaneously.
And finally, Section 5, critical CMA exam traps.
We've covered the mechanics, but as your teacher, I want to make absolutely sure you avoid the exact tricks the ICMA examiners are going to use to try and trip you up on test day. Consider this your definitive checklist, and I highly recommend taking a mental screenshot of this. Number 1, the fixed versus variable cost trap. Remember, operating leverage is driven only by fixed costs. Variable costs do not create operating leverage. Number 2, preferred stock. If preferred stock is present, remember that those dividends are paid with after-tax dollars. You must gross them up by dividing by 1 minus the tax rate before you subtract them in your DFL denominator. And number 3, the trade-off strategy. Companies with inherently high operating leverage, like an automaker, for instance, often intentionally keep their financial leverage very low to prevent their total business risk from completely exploding. See? Leverage doesn't have to be intimidating. It's really just a mechanical system of fixed costs acting as levers. Your company's destiny is shaped by its cost structure, so are you ready to master yours? You are now fully equipped to tackle these questions on the CMA exam. My advice? Take a deep breath, keep this confidence high, and head right over to your question bank to conquer a few DTL practice problems while it's completely fresh in your mind. Keep pushing, I believe in you, and I'll catch you in our next explainer.